All right, welcome back. Matt Davio, MissTrade here with Karl Denninger. Is it Denninger?
Denninger, yes.
Denninger. All right. Karl, I've been reading you for a long time. Your blog, a lot of people know as market-ticker.org, www. Great blog. I love your rants, but I want to get a little personal today. And seriously, I am a fan, and I agree with you, and I think more people need to be cognizant of what's going on. Tell me a little bit about how you got here in your life. You're an engineer by education. Where'd you go to school?
Well, actually, I left after 2 years at Western Michigan.
So you're another Michigan guy.
I guess you could call me that. I was in the computer science program, and when I started teaching the instructors, I decided it was time to leave.
That was probably happening a lot. I have a good friend at Purdue who said the same thing. He's like, yeah, I started teaching the classes.
Well, when you get to the point that you're making more money than you're spending on tuition, it's time to go do something else, and that was essentially the breaking point for me. I've worked for Fortune 500 companies, Fortune 50 companies, and as an entrepreneur, ran an internet firm in Chicago during the 1990s, MCSNet, very large regional internet provider. It was sold to Windstar in 1998.
Okay.
Windstar, of course, subsequently blew up. They were one of the big bankruptcies during the dot-bomb time in the 2000s. But it was an exciting time getting on the ground floor of something new. And being an entrepreneurial CEO was an interesting experience.
So were you the CEO of the company that was sold to Windstar?
Yes.
Okay, and once the transaction happened, did you stay on as an employee for a bit?
Well, for about 3 months. It was just really as a transition thing.
Yeah.
I didn't. They had a very kind of what I thought was a kind of whacked concept in terms of what they were trying to do. They were building a national network, which they mostly had in place, telecom infrastructure, and they were buying regional internet providers in an attempt to provide the services that run on top of that infrastructure, essentially a way to kind of build a vertically integrated company.
Right.
Not a bad idea. I thought some of the implementation ideas that they had were a little cracked in the head, but the check was good, and I had the intention to sell or take the company public at that point and decided that selling the firm was more appropriate for myself and the other shareholders. So between us all, we decided it was time to go.
I'm curious, when you did that transaction, were you paid in cash or were you paid in stock of Windstar, and were you thinking, I got to cash out of this, being where the market was?
That was a total cash transaction. The investment bankers that shopped it were given some very explicit instructions.
and I'm curious, were you thinking at that time, Karl, that hey, this market has gotten bubblicious? I mean, was this something in the back of your mind when you were running a business back then that we've got a great product, a great business, but there's some crazy things going on out there in the public markets? I mean, were you thinking about that?
Actually, it was a little more directed than that. We were one of the few firms out there that was profitable on both a cash flow and an EBITDA basis. So, as opposed to the cooked numbers that you were seeing from everybody, where they were looking only at EBITDA and not actual operating results, we were profitable on a cash books basis. So, no games, no gimmicks, no BS, and we're running with a 40% pre-tax operating margin with no debt. Nobody could figure out how. Well, no one could figure out how we were doing it, and that was one of the kind of the secrets. Was really just bare knuckled negotiation from a business perspective. But the problem was that everybody else that was out there was playing with leverage, right. And it was obvious to me that there was going to be a major explosion. Figuring out exactly when it was going to happen was impossible, and the internet business is a funny line of work because it's extremely capital intensive, and about every 18 months you have to literally bet the company on whatever it is that you do because the equipment has to be rolled over and enhanced. One wrong bet and you're done. Right. So, we'd made 3 correct bets over the space of the previous, 4 or 5 years, and I was like, with all the leverage out there and everything else, who's going to go down that's a critical supplier that potentially could get us? Yeah. And that became the larger fear. So combining with somebody that was larger was the appropriate thing to do. then the key was, okay, let's not end up taking on leverage personally as shareholders when we made the transaction. So between myself and the other shareholders, essentially I convinced them that taking capital stock in the acquiring firm was a bad idea.
Sure. Yeah.
And it turned out that it was.
Yeah. Well, so again, you're talking about a lot of issues that as investors, traders, we all deal with every day, and that is risk and leverage. Were you a participant in public markets or private markets, at this time or well before?
Oh yeah. Yeah, you have to do something with your money, and, that essentially was, you end up in some kind of market in some fashion.
When did you first start getting interested in investing and trading in markets? I'm curious.
Well, I was trading during the 1990s, during the time that I was running the firm as well. And essentially, in 99, I gave a couple of interviews in which I said, get out. Run, right. It's going to go boom. Right. And one of them is still floating around that you can find on ZDNet. Said that Amazon was a $2 stock. It ended up bottoming at $4, so I was off by half. But at the time, it was trading around 50 when I gave the interview.
Right.
So,
right. So but it probably went from what, 50 to 100 and then back to 4.
Yeah, I was early leaving, but it's better to be early to leave at the party than late.
I can't agree more with you, Karl. I can't agree more with you. So what kind of things were you trading in the 90s? Were you playing in the Peter Lynch model, playing in spaces and companies that you were familiar with? I mean, what kind of investor or trader were you?
Yeah, it was most of it was investing in from a longer term perspective, but there was a great deal of flipping of IPOs and things like that as well. Those were all short term trades. One of the classic ones was Market Watch. I got an allocation on the IPO and sold it the day of the issue, and got a really nasty call from the broker as a consequence because they didn't like you doing that sort of thing. And I said, you know what? I read the S1. It's a dog crap company, and I wouldn't own it for more than the 15 minutes it took for me to get my money back out. So I did. I made 75% in one day. What are you complaining about?
I mean, as an investor, and this is a great example, Karl. And again, I hope they called you back for more IPOs, but they probably didn't. But
not for a while.
That's the problem. Is I had a few of those also, and again, why wouldn't you sell it? What's wrong with the 75% gain? I mean.
Well, here's the thing, all right? I mean, this is the part that really burns me about this is that, of course, after the crash, we found out that all of the brokerages that were doing the underwritings and handling these allocations were taking the over allotments and selling them into the day of the issue, and many of them were shorting them at the time of the original issue. So, what are they complaining about? I was doing the same thing they were doing. I had read the S1. I had drawn my own conclusion about what I believed the business prospects of the company were, which is say it was crap. And I got an allocation of $15 and sold at $40. What are you complaining about?
Yeah.